Thank you very much, Jean-Yves Gerber, for this very warm and extensive introduction. Thank you also to Sabine Döbeli and Swiss Sustainable Finance for the invitation. It's a great pleasure to join you from Paris here today in Bern and discuss with you about the topic of sustainable finance. As we know, sustainability is not everything, but without sustainability, eventually all comes to nothing. So this is why it's a really, really important topic, and it's currently being mainstreamed in finance. And there are very important and exciting developments going on, especially in the European Union, and I'm very happy to share these with you. I'm also happy because our work in Brussels is still ongoing. So we are only halfway through, not even quite, and we are very interested to understand what's going on in Switzerland and to get your views and your feedback. I would like to cover 5 main points in my introduction this afternoon. The first one is just on how we see the issue of sustainable finance, how do we define it. The second is to think, what's the problem? What's the starting point? Why do we need to talk about that issue? The third is to argue why this is such a fascinating issue and perhaps goes far beyond the developments that we think are the core of the matter. The fourth is to tell you a little bit in detail of what happens at the European Union, what happens in the high-level expert group, where do we stand, what are the issues we're coping with, what are the next steps, and finally, to share with you some personal thoughts on what this could all mean for Switzerland. I understand that at the end, I also need to answer the question of the conference on whether Switzerland is on track. So let's start with a definition. I've seen in your case also the core definition of sustainable finance is finance that integrates economic, social, and governance criteria, the famous ESG integration. Maybe in a European context, looking at the very diverse functioning of the European economy, we also look at a second, somewhat broader definition, which would say that sustainable finance is finance that contributes to sustainable economic developments rather than boom and bust, sustainable social developments rather than inequality and exclusion, and sustainable environmental developments rather than the constant degradation of natural resources. So a little bit a broader, more economic context, and many countries in the European Union have strong hopes after the financial crisis that sustainable finance will also help in their economic and their social development. And the third definition, the broadest perhaps, is to consider sustainable finance as a system that is not just temporarily stable, but that actually is helping to address the major societal challenges. And in the European Union, very clearly, this is job creation, integration of the youth into the labor market, education, technology investment, energy transition, retirement financing, infrastructure, and climate finance. So these are very, very large issues, and the hope is that we manage to reconnect the financial system more strongly to these long-term challenges. And this is not just something we as actors in the financial system need to do, but it's very much also what the regulators need to do in order to orient the system and the whole economy more towards sustainability. I come to the second point. What's the problem? What's the problem? Why do we need to speak about that issue? Why is sustainability, if it's so important, not something that's very obvious? And I would say, are we there at the moment? Do we have something that we would call sustainability at a global level? And clearly the answer is no, we are not there. We have an economic growth model that is based very much on the exploitation of finite natural resources. You all know, of course, the issues on coal, the issues on oil, the issues on gas. It is also coming hand in hand with a lot of environmental degradation in many parts of the planet. It is pushing the planet to its boundaries. If you think of what happens in the oceans, the seas, the overfishing, the acidification of soil. So at a global scale, there are major environmental issues coming. And at the core are the issue of fossil fuels. So this is, whenever we think about that issue, also for the European Union, the priority is the E of ESG, and within the E, it's climate. So this is the core issue. Every European policymaker thinks, first of all, of this climate agreement and therefore of the fossil fuels usage. And you know that the famous analogy, if you think of the existence of this planet being 24 hours clock, so if you compress the 5 billion years that the planet exists in 24 hours, you know that human mankind we came sort of at 1 hour before midnight. Right? And the fossil fuels were maybe created at 10 p.m., then came at 11 p.m., the homos, and the exploitation of fossil fuels that have been created over millions of years really took place in a split second. Again, if we compress the existence of planet, just visualize it in a 24-hour clock. And this is really the issue, that this is not sustainable and that we need to take action in order to bring back our planet towards sustainability also in this area. Why finance? Why do we think about finance? And I would say this is almost the genius of the Paris Accord. The genius of the Paris Accord is the famous Article 2 that says, in order to reach the agreement of a decarbonized economy, we need to reorient capital flows. And the idea is that we can use finance for two reasons. One, because it's a very effective centralized steering mechanism that can help reorient our economy towards a lower carbonized economy. And it is something that also the clients of finance very much demand. The people that invest in us, the people that invest in the economy, are aware of the issues and would like to invest better and for the longer term. So this is how finance got into the focus. And we see at the moment sort of a tension between the finance side and the real economy. And the real economy are the firms, the energy firms, utilities firms, the transportation firms that are very much engaged in the transition. And the interesting thing is, if you ask these two groups who has to change, you get the same answer, the other. So the finance people, we say, well, we need much more indicators. We need to be able to assess whether firm strategies are in line with the climate decarbonization strategy. We need much more information of the firms in order to steer capital flows. And if you ask the firms, they say, oh, we need a much more aligned following of finance. We need to alleviate ourselves from the short-term pressure of finance, and we need a financial system that helps us on the long-term energy transition and on the long-term investment. And probably both sides are true. So the right answer is not to say the other has to change, but probably both have to change. So financial actors need to change, and also the firms need to change the way in which they produce energy and goods and services, in which they transport energy, goods and services, and the way in which we consume energy and goods and services. Currently, we have a world in which some financial actors can still pay only limited attention to this whole ESG universe. And we have a world where a lot of our productive firms only pay limited attention to these indicators. And what sustainable finance means is to enshrine these indicators both in the real economy side and in the financial side. We've been asking ourselves, what are the obstacles? What are the obstacles for us to move towards a sustainable financial system? And we are thinking around 5 possible obstacles, so to say, things where we say, that's what we would need, or this is what hampering the movement. The first is a clear policy roadmap. At this stage, the Paris Agreement might give a policy roadmap, but probably for economic and financial actors, it's not yet clear enough, not yet granular enough. So there is the expectation we would need a clearer policy signal of where we want to go and at which pace we want to go. The second is that we find that the financial toolkit is incomplete. We don't have, at least not consistently, all the relevant indicators to integrate these relevant variables on environment, on social and governance into our economic and financial decision making. So the second is incomplete toolkit. The third is more a question. It's the question whether our valuation models in finance are still very much focused, I would say, on conventional value, which is financial value, and is not really take into account a broader notion of risk. So we look very much at financial risk. Risk is the possibility to have losses, but these are financial losses, and these broader indicators are not yet part and parcel of our risk spectrum, at least not everywhere, increasingly so, but it's still a movement that needs to be accelerated. The fourth issue that we noticed when we talked to the regulators, and this is at least the case in Europe, that we have a regulatory framework that has paid a high tribute to liquidity. Liquidity is, among regulators, the game in town. So banks need to be liquid, financial actors need to be liquid, and so on. And this is understandable if we come out of a financial crisis with a lot of liquidity crisis. But if we want to move towards these long-term issues, we have to be careful that liquidity premium does not crowd out sort of these other investments. And the final point, I would say, is the one that Mark Carney famously called the tragedy of the horizons. And this is really the tension between, I would say, the short and the long term. The tension between the fact that our horizons when we manage finance, when we work in finance, is both, of course, daily, it is, of course, monthly, it is, of course, quarterly, it's annual, but yet the big societal issues are very long term. And so this is what he calls the tragedy of the horizon. So we need to think how we deal with that. So this is, I would say, the problem is that we are not quite there. We see a lot of very encouraging movements in private actors, in a lot of financial institutions, in society at large, but this is not yet completely taken into account in the policy frameworks, and this is indeed the work that is still ahead of us. My third point was to say why this is also fascinating. And this is, I would argue, because if we manage to deal with climate issues, which you know are decades. I mean, the energy transition, the scientists, they don't think in days, they think in decades. So they think 2030, 2050. And the idea is if we manage to help orient our economy to address these long-term issues linked to climate finance, we will also be much more able to address the financial and the economy to helping the other societal issues, which are, as I mentioned, employment, education, retirement saving, and so on. We see that all our main societal challenges are very much of longer-term nature. And there is the tension with a lot of part in the financial system. As you know, in our exchanges, more in the US than in continental Europe, the shortest time horizon of financial transactions is nowadays microseconds. You know that on our stock exchanges, there's something which is called high-frequency trading, where the time horizon is now 1/1,000,000th of a second. We know that there's a lot of day trading. We know there's a lot of pressure on corporate reporting on a quarterly basis. We know that regulation has a lot the one-year horizon in mind, especially for insurance. So this is the tension that we have, and this is also the challenge because we don't want to give up short-term finance. We need short-term finance in many respects, but we need to reorient finance to the longer term. And I would say also our people demand that. And when we speak about these issues with people, we hear sometimes climate skeptics. We say people are, especially on the other side of the Atlantic, is really this greenhouse gas, is that really the right metric? Is that the issue? Why do we need to control this? Are you sure this is human done, and so on? And maybe it's helpful to think that whatever we do, it's not just for the greenhouse gas emissions, but whatever we do in terms of climate transition is also good for the environment. Because the idea to extract millions of barrels of oil, ship them across the sea, burn them, waste them, the whole waste that is being created and so on is very detrimental. So climate finance is also good for the environment, I would say. And climate finance is also good for peace, because if you think of the last wars, in the Gulf especially, we have seen the extreme addiction to oil, what this can cause in terms of geopolitical tensions. So this is why I believe this issue of sustainable finance, climate finance, is so helpful and so important, and why our clients are so much carrying this issue, because they have really, really great hope attached to that. And coming from Paris, I must say, you have seen the reaction of the French president to the Paris Agreement. There's a huge attachment to this agreement in the city. I come to my fourth point, and that's what's happening in the EU, what's happening in Brussels. So what's happening is that the European Commission saw all these things about the climate agreement, the interest in environmental issues, and so on and so forth. And they asked themselves, how do we integrate this into our regulation? Because if you read the bank regulation, and many of you will have had the pleasure to read it many times, you will see that the word climate appears 0 times on these pages. Solvency II, everybody connects insurance world to the climate world. You can read Solvency II 3 times. The word climate doesn't appear. So for the Commission, it's not evident how to integrate all of this into their regulatory and their policy framework. And now they looked, I think, also at the international development and saw that there was something interesting, and that was a task force established by the Financial Stability Board on climate-related financial disclosures. And I say this because in this room there's one more eminent member of this group, who's Andreas Spiegel from Swiss Re, who has also spent 1 year of his working life, I would say the magic time in between, on this task force that tries to develop recommendations how firms and including financial institutions can report on climate-related opportunities. And this task force has been a very productive experience, so this has certainly inspired the Commission. So what the Commission did is it convened 20 experts who work a lot on this issue in the European Union. It gave us 10 observers to be sure that we are working diligently and hard. So the observers are, for example, the European Investment Bank, the European Systemic Risk Board, the Resolution Board, the European environmental agencies, and it gave us 10 observers from the European Commission itself. So we are sitting there in Brussels with 40 people around the room. The Commission itself is providing the secretariat, so we have the huge pleasure, I must say, and this is really something I would say unique, that we are facilitated by the regulators. So I don't know if the abbreviations tell some to you, but DG FISMA, these are the guys that normally write the rules and the regulation, they're providing the secretariat. And the patronage is by Vice President Dombrovskis and Vice President Katainen. So this is a big, big issue in Brussels. They have attached high hopes that something meaningful is coming along, and they have already committed themselves to look very carefully and work on the implementation of our recommendations. So the stakes are very high. But what exactly do they want from us? So we have read all the press releases and communiques 3 times, and we have distilled 3 questions that they ask us. And on these questions is what we are working on. The first question is, what is a sustainable finance system? What are the success factors? What does it mean in terms of capital allocation? What does it mean in terms of pricing? What does it mean for the European Union? So I would say the vision part is the first question they ask us, which we need to clarify, because this is sort of the basis on which we need to work. The second question, and they become more difficult as we go along, is how do we integrate sustainability into our regulations? And so when the European Commission speaks about regulations, they think about roughly 50 texts of several hundred pages, and these are the texts on the banking regulation, the insurance regulation, the market regulation, consumer transparency regulation, conduct, and so on. So we have to look at these texts and ask, how do we plug in sustainability into these amazing, amazing texts? So this is how to change the law, if you like. But the third question is perhaps the most difficult, and that's how we change the world. And the question is, how can we mobilize more capital towards sustainability investment? How can we make that more money flows into energy transition, into infrastructure, into the long-term projects? How can we mobilize balance sheets of banks and insurers, for example, and asset managers to long-term investment projects? What incentives do we need to give? What policy incentives do we need? What role should the EIB take? What role should we take in infrastructure financing? How can we get the Juncker plan not just to walk, but to run? How can we create projects and so on? And this is, I must say, a very difficult question to which we only have a rough, tentative answer, and we are really working very much along these lines. Let me give you a flavor just of each of these. I would say a sustainable system is certainly one that's productive, that's linked to the real economy, that's efficient, that's ecological, and that's resilient too. So that is robust to stranded assets, robust to sudden changes in financial market valuations, and that is long-term oriented. That does not disturb long-term actors through short-term volatility. The second question on how to integrate sustainability into the EU is something we look under several angles. First, there's a big angle about disclosures. We think we need, if we want to integrate ESG, we need more information about that. We need more disclosures. So we are looking at our TCFD recommendations, Andreas, very closely and think, how do we translate this into European Union law and framework? Should it stay voluntary? What should we encourage firms to do? So disclosures is something really, really important. And some, especially those who are French, have developed one article which is a number that is magic when you quote it in Paris. It's 173. So there is an article in the French energy transition law which is called 173, 173, and this is obliging asset owners to disclose whether their asset holding is in line with a 2-degree world, to say it simply. It's very demanding. We have done it at Axa. It's very complicated. We can only gauge sort of how we are positioned, but it's a very interesting exercise. So this disclosures is one point. The second point we're looking at is fiduciary duty. There's a tension as to whether asset managers and intermediaries need to take account of ESG issues or not. And especially from the US, sometimes we hear the view that you're not even allowed to do it because you would deviate from your fiduciary duty. So we really need to clarify, is it part and parcel of fiduciary duty or not? How do we have to amend the concept? We're also looking at bank regulation. And we're looking in particular at the question, first, of disclosures by banks, but also whether and how one could engage banks more in long-term lending. Certainly banks would not do 30-year loans on their balance sheet, but we believe that banks have a very important function in early stages of infrastructure projects, in taking development risk, construction risk on board, and then maybe securitizing this and getting it off balance sheet. So we're looking into whether banks can do more on project finance. And the tentative feedback, I just tell you where we stand at the moment, is to say maybe our regulatory framework penalizes long-term lending more than warranted by the risk dynamics. So that's very difficult to establish. So we will need much more work to come out on that. And also we have learned from bankers that the uncertainty over Basel 3, 3.5, 4, 4.5, I don't know where this ends, is distracting them from long-term lending, because they say the more long-term we do, the more we are subject to regulatory uncertainty. So this is maybe something that could come out for the banking regulation. And you see that we're not in the business of lowering regulation, we're in the business of trying to align it with the long-term sustainability objectives. For the insurance world, there is the famous Solvency II framework, which is a very ambitious, broad, strong governance framework, risk management framework. The question is, however, in the European Union, many insurers feel that they are underinvested in equity and underinvested in infrastructure. So they have to look on what would be factors that could facilitate a greater equity investment. And one other issue we look at very general is the time dimension, to see how we can help reorient regulations more towards the long term. On the third area, mobilizing capital, the issues we are looking at is first taxonomy, standards and norms. And we find that there is no single established taxonomy, what is green, what is not green, what is sustainable, what is not sustainable. So if we don't have that, we feel it's like the Babylonic confusion, so we need to clarify language here. And this could be one interesting deliverable of the group in the short term. The same for standards. There's a question, do we need a green bond standard in the European Union, or do we need one? Is that helpful or not? We can, you can all see the pros and the cons. So that's something also we are looking at. The second point is we look at policy roadmap. Where does the European Union want to go? And the policy incentives. Do we need policy, fiscal and other policy incentives to move along these lines? So this is giving you a picture of where we stand. The next milestone is that the group is providing an interim report that will be published around the 10th of July, and that will be discussed and presented in Brussels on the 18th of July. So the 18th of July will be a large event in Brussels, where the Commission will be there, the Parliament will be there, and with this report is there, and sustainable finance will be the topic of the day. And we are, with this report, trying to lay the basis to get feedback. So we are not yet coming out with fully fledged recommendations. We're coming out with policy options on these areas, and would like to get stakeholder feedback. And again, a warm invitation to all of you to look at this report and please give us feedback to see whether we are on the right track and what else we need to do. The Commission is working on this with an enormous resolve. The dynamics are very strong. And I don't know if you had the chance to look at the document that came out on the 8th of June, which was called CMU Mid-Year Review, so the Capital Markets Union Mid-Year Review. And that's a very interesting document where the Commission is taking stock, where we do stand, and you will see a lot of references to sustainability already. Sustainability in ratings, sustainability in supervision, Pillar 2 recommendations, and so on. So there's a big movement there, and the Commission has very kindly subjected itself to the deadline to consider all our recommendations in the first quarter of 2018. So once we come then out with a final recommendation in December, it'll go very fast, and the Commission is really, really determined to look at these issues quite quickly. I come to my last point, and which is, what does this all mean for Switzerland? And I'm the least qualified person in the room to assess that, but I can just, as an outside observer, tell you that for me, the issue of sustainability in Switzerland is a perfect fit. I must say that I think that's how I read the Swiss history. The enormous attention that this country pays to the future, the enormous attention that this country pays to the investment, and only I will try to continue where you very politely stopped in lauding the values of Switzerland, the enormous attention to the environment, to sort of coherence, to social equality, to social participation. I think these are enormous assets that, seen from the outside, make Switzerland a very, very prominent place to work on this. And of course, combined with a role in international capital markets, private wealth management, asset management, global banking, investment banking, combined with a lot of intellectual leadership, I think is a prime position for Switzerland to pronounce itself. The only invitation I can extend to you is to follow closely what your neighbor in the north, in the south, in the east, and the west is doing. So there are many important developments there. And as I said at the beginning, sustainability is not everything, but without sustainability, all comes to nothing. So at the end, the only thing I need to do is to answer the conference question, which is Switzerland on track? And I don't need a lot of time to tell you that, in my view, yes, it is. Thank you very much.